and I'm going to begin with you. I made the point earlier that if you talk about how a proposed tax hike could affect the broad market, don't forget that most of the broad market is in tax-deferred accounts of one sort or another, right?
Yes, that's a great point. Look, stocks don't like to hear about higher taxes, and that's why you saw the reaction yesterday. But I think the overall market is going to get over with that, and we're already seeing evidence of it today. We don't expect much of an impact from higher capital gains on the market. First of all, we think we're going to end up with a much lower rate than what is being proposed. 28% is also our base case. And also, when we do our analysis, historically, we have found little to no relationship between capital gains taxes and market valuations and market returns. In 2013, the tax rate was 9 percentage points higher, moved up. That year, market return 30%. When we look at historically, we had valuations as low as 10 times when the capital gains was 20%. And when the capital gains was 35%, valuations have been as high as 18 times. And the point that you made about investors is important because only 25% of the U.S. domestic market is owned by taxable accounts. The rest is pension funds and retirement accounts and foreign investors who are not impacted by this. So when there is a decline in the market, this is an opportunity for them to come and buy.
So, Lita, I want to drill down on that because that's a very important point you're just making here. You are saying that if you look back at history when capital gains rates have changed, either up or down, it has not historically meant that much to the market at all. In other words, when people know a capital gains hike is coming, they don't rush to sell. And when the capital gains hike goes into effect, it doesn't depress the market. And when capital gains, lower capital gains come in, it doesn't force people to sell. Lower capital gains don't mean more selling. Am I hearing you right?
To some extent. So the market returns, or market is really driven by earnings growth, monetary policy, fiscal policy. So those are the things that business cycle drives, I think, market returns. There is obviously an immediate reaction like we saw yesterday. There are some people who might need their funds sooner than later, and they rush to sell so that they can capture the lower taxes. But like I said, the bigger driver of the market is not necessarily capital gains taxes. And for investors impacted by this increase in tax, we did the analysis, and it really depends on your time horizon whether you should sell or not. Right. Because if you have gains and you have a longer time horizon, and we did the analysis of that, it might actually make sense to keep your gains and maybe hold on to it like 6 to 10 years if you're going to be invested anyway, because at that point you outperform by staying in the market and then paying higher taxes later than selling now and just paying lower taxes.
I see your point. In other words, if you hold on, you gain more by holding on as the return in the market continues than you would lose by selling and paying the tax.
Shepard Smith here. Thanks for watching CNBC on YouTube.